In 2001, one of the most admired companies in America collapsed in the matter of weeks. Over $60 billion in market value disappeared. But Enron did not fail because people did not know. It failed because too many chose not to look. Investors ignored the signs. The media amplified the illusion, and regulators did not stop it. This was not just a corporate collapse, it was a failure of the entire system. In the late 1990s, Enron became the symbol of financial innovation. Originally an energy company, it transformed itself into a trading giant, buying and selling electricity, gas, and future contracts on energy. By 2000, Enron reported $101 billion in revenue, making it one of the largest companies in the United States. Its stock price rose from around $20 in the early 1990s to over $90 by 2000. But what truly fueled its rise was not just performance, it was perception. In 2001, Enron was ranked by Fortune magazine as America's most innovative company for the 6th consecutive year. The narrative was everywhere. Enron was not just a company, it was the future. And once a narrative becomes dominant, it becomes dangerous. The financial media did not just observe Enron, it validated it. Major outlets consistently highlighted its growth, its leadership, and its innovation. Complexity was interpreted as brilliance, but very few asked a simple question: where was the actual cash coming from? Bethany McLean, a journalist at Fortune, asked exactly that in early 2001. How exactly does Enron make its money? That question stood out because almost no one else was asking it. The media simplified what should have been scrutinized. Growth became the headline. Risk was buried in footnotes. Because simple success stories attract attention, but complex warnings do not. At the same time, Enron operated in a rapidly deregulated environment. Energy markets in the United States had been loosened during the 1990s, allowing companies like Enron to expand aggressively into trading. But regulation did not evolve at the same speed. Agencies like the Securities and Exchange Commission were responsible for oversight. But Enron's financial structures became increasingly opaque. Special purpose entities and off-balance sheet partnerships were designed to hide debt. One of the key figures, Andrew Fastow, personally managed some of these entities. A direct conflict of interest, and yet it continued. Because Enron had influence, political connections, and heavy lobbying, and a broader belief at the time that markets regulate themselves better than governments do. When regulation is weak and complexity is high, oversight becomes passive. Enron was not just hiding losses, it was redefining how profits were reported. Using mark-to-market accounting, the company could record projected future profits as if they already existed. That meant deals that would take years to generate cash appeared instantly profitable. On paper, everything looked perfect. In reality, the company depended on constantly creating new deals to sustain the illusion. Former CEO Jeff Skilling once said that they were the good guys, and as long as the stock kept rising, that statement went unchallenged. The warning signs were not hidden, they were visible but ignored. Cash flow did not match reported profits. Financial statements became increasingly difficult to understand. Insider selling increased. In August 2001, Jeff Skilling suddenly resigned, officially for personal reasons, but confidence was already breaking.
This is a breaking
Even
news
then,
alert. We are
most
receiving
investors
confirmed
stayed
reports of a
in
major development
because
in the ongoing
leaving would
situation.
mean admitting the story was wrong. In October 2001, Enron announced massive losses. Shortly after, it revealed more than $1 billion in hidden debt. Trust collapsed instantly. The stock fell from over $90 to less than $1 in weeks. By December 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in United States history. Thousands of employees lost their jobs. Many lost their entire retirement savings, heavily invested in Enron stock. Enron was not just a company failure, it was a system failure. The company created the illusion. The media amplified it. Regulators did not stop it, and investors trusted it. This is how financial disasters actually happen, not through a single point of failure, but through alignment. Because the biggest risk in investing is not ignorance, it is collective belief without questioning. And when everyone believes the same story, that's usually when it's closest to collapsing.
If you enjoyed the content, subscribe to the channel so you don't miss the next videos. Leave your like and share. This helps the channel grow a lot. Thank you very much.